In this lecture, we're going to talk about equity valuation concepts and basic tools. When you look at the value of the value of the firm is a function of its profitability, how much cash is generated. It's about the growth. What's the growth rate of the firm? What's the risk associated with that? When we look at, we have estimated value, which is something we compute based on fundamental quantitative, qualitative information that we have, and that estimates a value. And we refer to that as the intrinsic value. And then you have the market price. What is the market for publicly traded securities? And that's what we're looking at right now, is what is the market price? So we would say a company is undervalued if the intrinsic value is greater than the market price. So when we calculate our values and it's below the market price, we would say that's an undervalued security. Fairly valued is intrinsic value equals, I'd say approximates market price. There's always going to be some variation here. And it's overvalued when the intrinsic value is less than the market price. Now, we will see this, and as we're going along, we want to keep this in mind. Because remember, the market price is what a willing buyer and a willing seller. They've made certain adjustments, certain they've made certain estimates, and they came up with one number. Estimates, as you know, are computed based on assumptions. So we have undervalued, fairly valued, and overvalued. Oftentimes we have uncertainty, and the first is our confidence in intrinsic value. I mean, how did we do it? Are assumptions solid? Is the methodology we learned? And then there's uncertainties related to the model that we're using, and that could be the appropriateness and the correct value and a set of assumptions. So there's this balance that hangs out there. When we look at valuation, they fall into three broad categories. Present value models, and that's really the dividend discount model, and a free cash flow model. There's multiple models, a share price multiple, enterprise value multiple. Then there's asset-based valuation models, which are looking at the fair market value of asset-based of the business and saying, okay, there's a book value, net book, and we're going to adjust that up or down based on the market value of those assets. So those are the three categories: present value, multiplier models, asset-based. The one that we're going to focus on and that we've been leading up to is the present value of cash flows. And as you know, the net present value calculates the monetary value of the project's future cash flow. So you already have a forecast that we've talked about, and it's part of the project, but we've done the forecast. Now we're going to take that forecasted cash flow and we're going to present value it back to determine what the present value of the cash flows are. We will compare that to the market price and determine if it is undervalued, fairly valued, or overvalued. So it's really based on the belief that the value of a company is its ability to generate cash flow in the future. Not just earnings, but cash flow. And if you believe that, then the value of the company is the present value. Now, how does an investor make money on an investment? Well, they make it from cash flow from dividends or gain or loss when they actually sell the stock. So what do we value? It depends on the company. Now, the present value is I won't say it's easy, but it's not that complicated. You have a 5-year cash flow projection. So you just compute the present value of that. Well, not exactly. You need to make a few broad assumptions. What's the discount rate you should use? Because we're discounting a cash flow series back. What discount rate should we use? Oftentimes it's the investor's weighted average cost of capital. You have only 5 years of data, but what happens at the end of 5 years? So you have to make an assumption about what happens at the end of the 5-year period. Do we sell the stock? Yes, that's a residual model we sell it after 5 years, so we would need to compute a value at the end of 5 years as well as the cash flow. The other is that it keeps growing into perpetuity, and we pick a number of the growth rate. But remember, as we present value things back, the farther out you go, the less the present value of that is. A couple of the models that we use is our dividend discount model, our free cash flow model, free cash flow to the firm, free cash flow to equity, and then residual income models. So we're always doing discount. We're using different approaches of what we're going to discount. So how do we decide what to do? One is we use a dividend discount model. If you have a company that is growing at, we'll say, a normal pace, not growing exceptionally fast, but growing, has a history of dividend payments, and dividends are directly related to earnings, that they're paying out a fairly substantial amount of earnings to the shareholder, because then we're going to discount the dividends. Okay. Then cash flow models, that's what we're going to look at. One, it takes a little more work and assumptions, but the dividends are not material to the investment. What we're really looking for is growth. We've got companies that we think are going to grow, and there's really positive cash flow related to earnings. Controlling perspective could be residual income. That's when there's small dividends, but there's negative free cash flow over time. And there's really a lot of stuff going on, shall we say. So we're really going to focus on these two here, when we're doing that. So in a very simple way, if we're using dividends, it's the future benefits as the dividends, so we take the present value of that stream, okay? The future benefits of that free cash flow is here. So I show this here, but I want to just point out a few things. The higher a company's cost of capital, the lower the present value of a period's cash flows. Okay, so when you're computing that weighted average cost of capital, you're going to use that in your discount, but you also have an investor. So you got to look at Mr. Success and what is he looking for. Given that constant cash flows, the further out in the period you go, the less the cash flow value contributes to the value of the company. Now, we said we have to make an assumption as how much the company is going to grow into perpetuity. Well, the higher the terminal growth rate, how long you expect that to grow, the higher that component will be. But it cannot exceed the growth rate of the economy as a whole. Okay. The one that we use for dividends, we use that, and it's the Gordon growth model. You should pay attention to that. Dividends are the correct metric to use for valuation. The dividend growth rate is forever. It's perpetual. And the required rate of return, and it's a calculation that we have. Okay? You just need to know for dividends, we use the dividends growth model, which is the Gordon growth model. So this is when we sort of look at it in different ways. Companies have a life cycle, the growth, transition, and maturity. So when we're looking at growth and transition, we're using free cash flow. Okay? As we move into the end of the transitionatory period, into the maturity, what we're then going to look at is the Gordon growth model. Let's now take a look at how this works. In the Excel file, Steel Dynamics worksheet with the date of June 14th, Flag Day, is the one you want to use. And I've put in a model here for you, and if you go to the bottom tab, it says DCF, discounted cash flow, BAU. I've done one for my bear, and I've done one for my bull. So what I have done is built a worksheet for you so that you have to just bring in the earnings before interest and taxes from your forecast. And if you go over to your forecast BAU, we come down and here's our earnings right here. We'll just highlight that for you. Our earnings before interest and taxes. So that comes in, and I've set the tax rate down here to be 30%. That was my assumption. And it computes the provision for taxes, and it gives us an unlevered net income. Okay. Then I've added back the depreciation. That also came from my forecast. And I subtracted out the capital expenditures based on my forecast. Now, 2018 is actual, 2019 is an estimate. So then we have two choices of how we're going to value the company, how are we going to deal with that end of the period. So we're going to discount this cash flow here. Okay, this cash flow is going to be discounted, and then we have to do something at the end of 2023. So we have two things we're going to do there. Before we get too far along, you input the tax rate, you input the debt, and you impact the number of shares the company has. Okay? So the model here, the first piece, is our exit multiple model. And what that does is this assumes this right here. We'll highlight that for you. Let's use a bright color. Okay, exit multiple. And what that's saying is at the end of the period, when we get to the end of 23, we're going to literally sell the company, and we're going to value it as a function of earnings. So what we'll look at is, in this case, I've selected anything in the light blue you can change. At 10, that at the end of the period it would be sold for 10 times EBITDA, 12 times EBITDA, 14 times EBITDA. Okay? And then I picked my discount rate, and I used 12.5, 15, and 17. This is an input. This is input. Okay? And what it does is this computes the net present value of this income stream here and the value of this at the end of the period times the multiple. Okay, so if you look at that formula, you can see what that is. Then what it does is it tells us what the implied terminal is, what percentage it is. But the ones we're really focusing on here is when we use all of that, this is what the company is worth in totality after we take off the debt. And then it divides it by the number of shares, and you have a range. So in this case, if you're using 15% cost of capital, based on your earnings multiple of 10, 12, or 14, it's worth between $45 and $60 a share, 53. It's a range. Remember, my assumption is built on a whole series. So when we're valuing, we're looking at ranges. Okay? So you can see that how we make an assumption on what these are and our cost of capital is going to end up varying the value of the company. Okay? And the tighter we make the assumptions, the closer the value will be. But it's all based on interest before interest and taxes. Okay? And that becomes an important aspect of the company. So as you can see, if I were to change this, let's see what happens. So as I lower the discount rate, say I go 10, 12, 15, the value here goes up. Okay? And if I tighten this and say I make them all the same, you'll see they're all the same. But that would tell us then, if we're using the multiple, depending on the discount rate, it's between 45 and 57. So I'm just going to go back and put 12 in here, 14 in here, their numbers, and that's the PE ratio. And oftentimes we see the PE ratio, we can compute it. So that's our exit multiple model. When we come down further and look at this, we are using a terminal growth, a perpetuity and growth method. So this one, we're selling the company at the end of the 5 years based on a multiple of EBITDA. Here, we're assuming the company grows forever into perpetuity. But again, remember, as we discount that, that becomes worth less and less. And we come up, walk through the same thing. These are assumptions. We do keep these the same. These we don't change. This is one that for each case you put it in. And what you do is, again, we see a different range. Now, what we can see is that when we're using it in perpetuity, if we're using 12%, it's worth between 41 and 51. Here it's worth 52 and 69. Essentially, what that's telling us is that if we do sell it at the point in time, that would be a good price based on the growth. So we make assumptions. But these are the two models that we use. They're all built on EBITDA, making a number of adjustments, and we end up with this unlevered free cash flow. We have to input our numbers here. Don't forget to do this. And that will give us a value of the company. Now, I did this for the bear and the bull. So when I get into there, I'm using a different set of numbers. And as you can tell, I am getting a much lower number. But that's the bear case, when I'm not looking for a higher number. When I look on the bull case, we can see it's worth more. So that gives you an understanding, hopefully. You can see it. You can check the worksheet out. And that's the valuing using the free cash flow. So that is going to end part one. When we go on to part two, we're going to look at the other methods. Please let me know if you have any questions.